Welcome back. So the market's doing pretty okay. 34 points on the Sensex. The Nifty is looking up as well. And the markets across Asia will come up on your screen. Nikkei, so what, 16,958 odd, about a third of a percent higher. I think trading is...
third of a percent lower.
Third of a percent lower, sorry. I mean, I'm seeing things today.
And it's closed, and it's closed for trade now.
Closed for trade today.
Or just about closing for trade. So that's the final tick that you're getting. It's largely been a session in the red, mildly in the red for most of Asia today.
Most of Asia. So lackluster, I mean, absolutely. Overnight session was also pretty... sort of nothing to really take away from the overnight session per se. All right, let's now talk about the retail participation in the markets. Markets are at new 52-week highs, just a knock away from an all-time high. But what is the level of retail participation interest in the markets at this point in time? And what is holding retail back, and what can be done to sort of bring retail back into the markets? We have Vinay Agrawal, CEO of Angel Broking, and Vaibhav Agrawal, Head of Research, Angel Broking, joining in on the show. Gentlemen, thank you very much, both of you. Appreciate it.
Good morning, Prashant.
To begin with, so you guys have launched a product called ARQ, which we're going to talk about in just a bit, but just to kind of provide the context for this, what has been the retail participation in markets like, as you see it, in this phase of the bull market, you want to call it a bull market, and the last bull market?
Yeah, so there are two things around it. So the first is, when you look at the participation of retail, in the last 2 years, you have seen a considerable change in the way the retail was participating. So if you just look at some data points, let's say, for example, if you just look at the mutual fund numbers, last 2 years, the amount of retail inflows that you see is probably more than what you have seen 10 years preceding that. If you look at the client addition in the Demat account, it has grown substantially. So if you look at FY13 and FY14, we used to add close to 18 lakh Demat accounts a year. If you look at 15 and 16, we were adding close to 25-26 lakhs Demat accounts a year. And if I extrapolate the current year, we may end up doing 35-36 lakhs Demat account, which is like, from 18 lakhs to 36 lakhs over next in 3 years, which is phenomenal. But at the same point of time, for larger financial inclusion, it is also important that we kind of fill the gaps, as you rightly pointed out. There's still some hurdles which retail investors have.
How do these numbers compare to, say, the 2005 to 2007 phase? Do you think activity is back at those levels?
So the retail activity is still not at that level, but if you look at the number of new additions that is happening, it's higher than what it used to be in 2007. So what I mean by activity is, when you look at number of clients who have opened the account versus number of clients who are traded on a daily basis or a monthly basis, that used to be much higher in 2007. But if you look at the number of people participating in the market, that has grown much. This is much more higher now compared to 2007.
Okay. So tell us more about this product that you've launched for retail investors, ARQ. What does it do? Where is it available? When did you launch? How much interest?
Yeah, sure. So as Prashant was rightly identifying it, the real issue is, for retail, there are two bottlenecks. The one is the fear of losing money into this market, which I call it as a risk appetite. And second is, based on the risk appetite, getting the right advice which matches his profile and his risk appetite. So for an ultra HNI, there are still a lot of options available to them. They have good senior RMs or advisors, talking to them on one-to-one basis. But when you look at retail, you don't have that flexibility. So they have a lot of recommendations floating into the market, but for them it is very difficult to choose one of them. So that's how we kind of fill this gap with launching this product. So the ARQ, what typically it does is, it takes the advantage of leveraging on this whole digital ecosystem that has got built. So now with high-speed internets available and smart gadgets available, you are able to use that ecosystem, as well as the computing power has gone to a completely different level. So what we have done essentially is, using this technology and the digital ecosystem, we have created a product which understands the customer's needs, it analyzes the risk appetite of the customer based on the profile, using a modern portfolio theory, which is a Nobel Prize winner theory. It allocates the assets, and within each asset class also it recommends what is the right script for him to buy. So this way, a retail customer is able to get a one-on-one personalized advice without paying any fees and without committing any large sum of money to be invested.
Vaibhav, you've kind of worked on this extensively over the last 1 year. Would you like to add something to what Vinay has been saying?
So as he was saying, we use the modern portfolio theory to really give the asset allocation. Now, how does that work? For every level of risk, right, it tries to maximize the return that an investor can make using the diversification benefit between different asset classes. I'll give you a small example. Let's say there is a 100% bond portfolio, okay? If you look at the historical data on that portfolio over the last 14-15 years, it made about 6.75% return with a volatility of 3.6%. Now the insight with modern portfolio theory is that instead of that 100% bond portfolio, if you were to take 68% bonds, 14% equity and 18% gold, all right? Because of the short-term negative correlations between these assets, over that period you would end up with the same volatility of 3.6%, but your return expectation instead of 6.75 would be 8%, right? So for the same level of risk, you actually end up making more return, right? And it does that across the spectrum of risk. As the person's risk appetite is higher, he can actually take more risk. Maybe the equity proportion will go up, but for every level of risk, he gets the full benefit of diversification so that his risk comes down and return goes up, right?
Vaibhav, if say for example we have a hypothetical 100 rupees to invest and you've already rolled out ARQ, what is the kind of interest that you're seeing in terms of asset classes, that 100 rupees divided between equities, debt as well as gold at this point as compared to earlier?
So, obviously, the way this works is it's not specific to, the near-term outlook on these asset classes. It's meant to be a portfolio level sort of a long-term product. So depending on different profiles, there would be 10, 15, 20 different profiles. Each person would get the recommend proportion of, let's say, equity, debt and gold based on his profile. Now, within individual profiles, let's say equity, we will recommend him, the specific stocks or mutual funds based on their near-term performance outlook as well. So, our stock products would get, a notification every month. Do they need to keep those stocks or churn into different stocks? Point is, they need to be, invested in equities over a longer term. Within that, which stocks or mutual funds to hold, that will change based on our advice.
So, I mean, just to give an example, if a retail investor walks into an Angel branch, how does it work? What questions does he get asked to assess what he wants to do with his money? I mean, just Vinay, if you can take us through that.
So the questions are very simple, but they're very smart questions. So knowing that retail investors are typically laymen, the financial understanding may not be great. So the kind of question that we ask is, it starts from a simple question like, the age of the customer, the time horizon of the investments that he wants to look at, and then it also asks some interesting questions about what is his risk willingness in this sense. So it asks you a question saying, if the markets were to go down by 20% and your investment portfolio has taken a hit of 20%, what will you do? Would you sell? Would you panic and sell? Would you hold, or would you buy more? So this kind of simple questions, which are easy to answer by the retail customers, but help us to understand what goes in his mind. Because if you ask a retail customer whether he wants to take risk or whether he does not want to take risk, it's too tough for him to answer, because he himself does not know what does a risk appetite mean. So by asking these smart and simple questions, we're able to kind of profile him and suggest a right recommendation.
The focus is on risk-adjusted returns, as it should be, right? I mean, across the board.
Right. So that is, I think, that is one part of the overall ARQ offering. But when you come to the second part, which is how much within equity, what should you hold? I think there what we have used is a whole lot of back testing. We've used very scientific processes.
I actually wanted to ask you that, since you've back tested this, how often does this throw up recommendations? I mean,
right. So
it's real time.
It's real time. It keeps taking data and updating it, and so on a daily basis, recommendations get generated. From an investor point of view, though, let's say if you take the mutual fund product, once we
you said it's for the investor, right? It's not for the very near term, right? But it will. So I'm just saying, I mean, trading costs are also a significant percentage of overall returns eventually.
Right.
So how often does it ask you to churn your portfolio?
So we actually do in fact build in all transaction costs, STT, brokerage, everything while we are actually back testing. And I should say that the portfolio strategies are optimized for a minimum horizon of 1 year, right? Within mutual funds, we would never ask a person to, churn it out before a year. There would never be exit loads or capital gains tax. But I think in stocks, it does not make sense to just, leave it like that. We run the model, constantly, and if based on, the dynamic changes in the market, if there is a need to, sort of change stocks, we automatically notify the customer on a sort of a monthly basis, so that he knows what to do. He can manage his own portfolio using this sort of automated notification system.
Okay. All right, Vaibhav as well as Vinay, thank you very much for joining in and
Good luck.
taking us through this product. And I hope we see more retail participation increase on account of such kind of technology hitting the market. We'll take a break now, but up next we're going to be discussing one